All right. We want to start off this year by first saying Happy New Year's to everyone that listens in. And today's monthly discussion, we're going to cover a lot of very timely topics. I know there's a lot on everyone's minds. One being this recent volatility. I'm sure we want to talk through some of that, some of the causes, as well as we'll dig a little bit deeper into inflation, as well as the recent notes out from the Federal Reserve, and then some planning ideas going through into the rest of this year. So first, JR, what's causing some of this volatility?
Well, fortunately, it's been a nice, calm start to the year, nice and easy, no issues, right? Obviously, it's been a lot of ups and downs. And the challenge we saw, just like the day after Thanksgiving last year, where the markets have a big, sharp decline, it breaks a lot of the technical trends in the marketplace. And then you just get this effect of a lot of volatility. And that's what we've seen. But what's a little different now is the change of expectation, as you said, from the Federal Reserve and interest rates are two big ones on top of the inflation. And put all that together and you've seen some major volatility, which is here to stay, unfortunately, for a while.
Right. And agreed with a lot of the AI stepping in. But I think also to note is a lot of the new investors that came into the market last year. It's estimated that 25 million new investors started participating for the first time. And with that is a lot of any volatility is going to be new to them, especially any downturn, whether it be 3 or 5%. So some of the behavioral finance triggers for new investors are brand new and could be enhancing a lot of this volatility, whereas some more experienced investors are weathering the storm a little bit better emotionally. So that could be enhancing a lot of this as well.
Michael, are people buying the dip here?
You know, probably a few people are, but big picture, I think it's best to hold off on buying this specific dip. I think, you know, when you're looking at different companies, there are going to be some opportunities out there. But when you're seeing a lot of the big growth names that are, or say like a $80 stock, $100 stock that are now trading at $40 or $50, it's hard to kind of say if they're, you know, maybe they'll get back up to that $80, $100 level if they don't have any sort of fundamental earnings, they aren't paying a dividend, this or that. So it's very easy for those types of companies to, you know, fall another 50% from where they are. So to necessarily buy those high growth dips, probably stay away. But again, find your pockets of opportunity where you do have some fundamental real value, and you should be, you may make a bit of a return there.
And
let's look at one of the big changes this year are interest rates. Right?
For sure. So when we're looking at you're looking at interest rates, you know, the big news is really of how fast the Fed has really changed its tune on increasing interest rates. You know, if we go back, call it 6-7 months, you know, the expectations in the market were we might get one rate hike in 2022 in this year, and maybe two in the following year. But now when you look at these charts, you're seeing that we're seeing the interest rate hikes accelerate greatly, where, you know, we see 3 or 4, or the market's expecting 3 or 4 rate hikes this year, maybe even 5. And with that in mind, it's just putting a lot of pressure on valuations for different companies. But the goal of increasing the, I guess, increasing the rate of the hikes and sort of when they're being done is really to try and control inflation. Because when we're at this 7% rate of inflation, it's really starting to hammer a lot of families that are, they have to deal with, you know, rising gas prices, rising grocery prices, rising rents. And the Fed, they're trying to help these households out. And if the way that they can do that is raising interest rates, you know, that's what they want to do. But they do need to also take into account their current tapering program and the balance sheet as well. Because as the Fed, as they start, they continue their taper program, they want to reduce the amount that they're printing and really find make sure the markets are at a stable point before they raise interest rates. Now, I think the question is going to be, do they wait, or how long can they wait before they start raising interest rates? And JR, do you have any thoughts on that?
Well, if you look at the Fed going all the way back to Ben Bernanke, is they're trying to be as transparent as possible to the markets. And to your point, Michael, they're being transparent about not having to do too much this year, but then inflation got way out of their expectation range. So they've really had to quickly adjust policy, and that's really what's changed in the last month and a half from the market perspective. And when you look at this shocking graph of the Federal Reserve balance sheet, you know, there's concern that the Fed is going to go from a very accommodative policy. And usually the Fed goes from a very accommodative policy to neutral to then kind of a tighter policy. The market expectations, because the inflation worries, a lot of people in the market expect the Fed to skip neutral and go right to tightening. What that would mean is raise interest rates at the same time reducing the shocking balance sheet that we're looking at. The reality is, I think that the Fed might have spooked the market enough or shocked the market enough that they might not have to do as much as the market is worried about right now. Because again, if you look back 10 plus years ago, we were talking about the Fed reducing the stimulus from the financial crisis in 2008, when at the time Bernanke had printed $1 trillion, that blip on the far left part of the graph. And you could see what happened. The Fed never exited that stimulus from the financial crisis. They tried in 2018, and we had a bear market in the fourth quarter. So it's very difficult to go from accommodative to tightening at the same time. The Fed's very conscious of that. The tricky part is inflation. But again, it feels like the short term, you had the slowdown to start the year with Omicron. So the economic growth, the first quarter is going to be slower. So you might see some of the inflation expectations and actual results ease here, which will help the Fed not have to tighten quite as quickly as the market is expected overall. So it's something to watch for near term. Again, it's going to be very data dependent, but I think that the expectation might be a little overdone.
Jared, do you think the balance sheet ever falls back to where it was at, pre-COVID?
Well, it's gonna have to moderate clearly. The other thing that's interesting now, because of where the Fed is, it's been a long time since you could trust what the interest rate market is telling investors. Because you go back prior to 2008, there was always a philosophy in the markets that the bond market knows all, sees all, and is smarter than the equity markets, meaning that if interest rates were going up and it was contrary to what you were seeing in the stock market, the bond market was right. And it feels like we're going to get back to that. So it's going to be interesting. We'd expect the balance sheet to slowly moderate and go down a little bit, but the odds of going back to pre-COVID balance sheet levels just do not seem like it's going to happen. And our precedent is going all the way back to the financial crisis.
And the other interesting thing to note from Powell's discussion yesterday was one reporter brought up the yield curve and if the Fed should be paying attention if their yield curve inverts over time or becomes flat. Is that something that they have tools for, or how are they going to be looking at that?
I think the Fed is very mindful of that flatter inverted yield curve. They really don't want to necessarily manipulate, but when you have an almost $9 trillion balance sheet, there are plenty of tools available to the Fed to sort of have a steeper yield curve. Because if we could trust interest rates again for the first time in a long time, to your point, if the interest rate yield curve starts to flatten or short-term rates are higher than long-term rates, meaning it's inverted, that's historically a sign of a recession or a major slowdown ahead. The Fed is very conscious of that, so they do have the tools available. Whereas a steep yield curve, meaning short-term rates are lower than long-term rates, that's usually a good sign of economic growth ahead. So yes, they have plenty of tools available to kind of keep the yield curve steep.
And so I know we've touched on the inflation figures already throughout this call, but obviously just to recap, so December's numbers came in at 7%. It's overall a very high figure, and the PPI, the producer price index, came in even higher at 9.7. So that's something that we want to pay attention to, and obviously the Fed is really keeping an eye on that. I think they switched their tone overall from very hawkish, or from dovish to hawkish, and they were very humble in making that full transition because it was a very drastic one. But with numbers like this coming in, they have to do something more drastic to keep a lot of that in check for long term.
Yeah, when you look at the impact of wages, the next graph, it's really the first time in a long time that you have inflation running at a higher rate than wage growth. So the good news is you're seeing a big catch up on the far right, because historically wage growth is faster than inflation. And that's a good sign. If we could have low, stable inflation and wages grow more than that, that means that there continues to be growth in spending in the economy. The challenge is if inflation outpaces wages, that is going to be a problem for, as Michael, you said earlier, for consumers to keep pace with food and energy and everything else, you need higher wages. So it's a good thing to do. Jamie Dimon was quoted in his earnings report, kind of calling out CEOs to, in effect, calling not to be crybabies about having to pay higher wages. And again, when you think about that, I always go back to Milton Friedman. There's a big debate right now over maximizing shareholder profit or shareholder value under the whole kind of ESG movement. And again, I believe if Milton Friedman is still alive today, I think he'd be much more in the shareholder value category, which meaning if you increase wages, that isn't necessarily good for short-term profit. But if your stakeholders value that more to take care of your employees, to have a good culture and those kinds of things, even though your short-term profit isn't maximized, your shareholder value more than makes that up. So I think it's a trend to watch for. That I agree with Jamie Dimon that wages should go up. You have to with all the inflation, but as you adjust over time, that'll start to moderate. But again, I believe companies that are conscious of that and quote do the right thing and take care of their employees will more than make that up in shareholder value with higher multiples.
Yeah, it's for sure important to sometimes step back from just looking at the numbers and look at just the societal benefit of increasing wages and just how that the spread out of the of wealth will just benefit everybody in the long run. So, and just kind of talking about things shifting over the long run, we've been talking the past couple months about seeing a rotation more from your growth stocks, your high valuation stocks, towards your dividend payers and more value oriented equities. And it's really been what's been playing out so far this year. And when you look at talking about the volatility that we've been seeing so far within the markets, you look at, say, the top 5 companies in the S&P, they're all tech companies, and they make up about 25% of the index. And when you look at, say, the top 10 companies within the index, their average PE is in the 30s, and the expected PE ratio of the S&P is in the mid 20s. So what you're really seeing is just this rotation from the high growth names that have these high valuations that really aren't sustainable to more of the value oriented names that are going to, again, pay you that dividend, that are going to be more successful based on their fundamentals and have a bit more just underlying value as opposed to the high area or the high growth area stocks.
And again, Michael, with that, because the expectation of interest rates rising, that's where the multiple valuations come down as well. And so you kind of have a double-edged sword on some of the high growth. Growth might be slowing a little. Interest rates are going up at the same time. So multiples come down, and the shift that has occurred will likely continue and play out the rest of the year as well. Because a lot of this, what's being called is kind of the revenge of the old economy. You think about that logically, a lot of that are value-oriented companies. What's wrong with a 10, 12, 14 PE ratio as opposed to 37 or 100 and a solid dividend? That's what we believe will continue to be in favor in this environment.
Right, and that's what I was just going to mention that Michael touched on earlier too. Is this the time to buy the dip? That's a perfect example of some of these PEs are still not really holding true, and most likely will have to pare down to get back to closer to their real fundamental values. So this is probably not the time to buy the dip in some of those very high growth momentum names. And so another thing that we wanted to touch on here was financial New Year's resolutions. And while it might be the first time for some of you, or it's just keeping up with some updated information that's come out. So 401ks have gone up $1,000. So if you were contributing $19,500, you're up to $20,500 now, as well as maxing out at 27 if you're over the age of 50. So make sure to check that off or update your contributions for the rest of the year. Additionally, if you were already annually gifting to maybe relatives every year, that has increased another 1,000 as well. So it's going from 15 to 16. Keep that in mind. And this is a great time to continue to get a lot of those assets out of your estate long-term and help transition the wealth to the next generations. Additionally is with the interest rates rising, the AFR rate. So interfamily loans are another great planning tool for many families, and that is to help lend to your families or other members at a lower interest rate now and locking in those low rates, because when interest rates hike throughout the rest of the year, that AFR rate will go up quite a bit. Right now it's in the 1% range, so it's very inexpensive from that standpoint.
Sure. And also for if you aren't contributing to a 401k or making the annual gifting or annual exclusion gifts, remind your kids, remind your grandkids that these are things that they can be doing as well, at least on the 401k perspective. And depending on your relationship, if they were good last year, you can increase up from 15 to 16,000 and make everybody happy.
So as we kind of recap what's going on right now and look out to the rest of the year, I mean, so far the earnings season has been somewhat as expected. Most companies' fourth quarter results were amazing, right? I mean, record levels. The challenge has been in the outlook. Who's been able to maintain margins and pass along with all the inflation? So that's really hurt some companies individually. The other challenge has been, as we've been talking about, the high growth valuations. If you had a growth rate at 70 or 80% and it slows down to 40%, still growing like crazy. But with interest rates and the growth rate coming down, that's just been a bad combination for the very high growth rates. So we're mindful of both of those trends as we look into the rest of the earnings season and look ahead. And as we're thinking about the challenging environment with all the uncertainty, I mean, we talk about our crisis playbook in times of uncertainty. I don't think we're there from any stretch. We're just being overly cautious here near term, given all the uncertainty. So a lot of what we like to do, whether it was in March of 2020, is somewhat counterintuitive. You need to have a little extra cash in the portfolio to take advantage of opportunities, because anytime the market drops and has big moves like we've seen in the last few weeks, it's hard to watch and live through. On the other hand, it does open up long-term opportunity. But if you didn't have a little extra cash in the portfolios, it's hard to take advantage of those. So we just like to be a little more defensive here near term, because again, it's not that we're super negative about the rest of the year. It's just there's a lot of uncertainty here near term between what's going to happen with inflation, Federal Reserve policy. So we tend to sell and have raised the extra cash here in the last few weeks. And again, depending on how the markets settle in here, we may either be a little more defensive or we'll look for the signals to kind of take advantage of those opportunities that are out there, because there's a lot. Because on the tech side alone, you got to be careful. But on the other hand, not all tech is created equal. There is still a lot of real growth out there, and the ones that are being overly punished because everything is done, there is opportunity there. It's just a matter of being very selective. So with that, we want to thank everybody for tuning in, and we'll touch base next month and see how we position from there to the rest of the year.
Thank you, everybody.